Hello and welcome to our next session on IND AS. So we started with the series wherein we briefed about why IND AS, what is the objective of IND AS, what is it that is going to change by implementing IND AS, what was the phases in which IND AS got implemented, what are the precondition to which basis which IND AS would be applicable to any corporate, whether listed or unlisted. So in fact, all listed companies are required to get themselves to adopt the IND AS, but capping is there for unlisted company, which is less than 250 crore of their net worth. Now, we said that we are going to cover each and every IND AS in detail. So today we are here to present the first IND AS, which is IND AS 1, which is presentation of the financial statement. So what we have then done, we have covered all the aspect which are relevant to have the understanding of the IND AS, and it has been kept in mind that while preparing this presentation, that focus should be given on the key points, key notes, and also to ensure that wherever there is a deviation or there's a gap between the IND AS versus the applicable international accounting standard or IFRS, those are highlighted. But if they are aligned, then it is also mentioned that there is no change and the alignment is there. We also tried to bring out some changes and the differences of the IND AS versus the earlier Indian gap, and we can see that why those changes were and what has been changed in the IND AS. So with this, we can quickly start the discussion. The points that we have covered here is the objective, scope, complete set of the financial statements, fair presentation and the compliance, going concern basis, accrual basis, materiality and aggregation, offsetting, frequency of reporting, comparative information, current versus non-current, balance sheet, P&L, other comprehensive income, statement of change in equity and notes, and then a quick summary. So this is how we have designed the entire presentation. We'll just quickly move to the first slide. Okay, so let's just quickly touch base the objective of IND AS 1. So we know that IND AS 1 is basically the presentation of the financial statement. The objective here is to ensure that when we are present, when and as an entity or a corporate is going to present the financial statements, there are two important things that we need to keep in mind. That whenever they are presenting their financial statements, it should have a fair presentation wherein we can do the comparison between the entity's financial statement with either the previous year, and then if at all we want to compare the financial results with two entities, then we can do that. So which means that it creates the framework basis which corporate needs to adopt that framework and present the financial statement. When the framework is being adopted and all the entities are reporting their numbers basis that framework, so which means that comparability becomes easy because the format is standard, the framework is standard, and the adaptability of the standard framework ensures that when the numbers were compared to compare with two companies for the same industry, or we need to compare the benchmarking between the two companies within the same industries. We need to calculate the, let's say, performance. We need to calculate, let's say, the PE ratio, or we need to calculate, let's say, the ROE or the dividend ratios. All those things which can be calculated can be done. This is the comparability because we have the financial statements which are available, which can be comparable, and then once they are comparable, we can evaluate which company within the industry is doing better. And it's also ensure that in fact when we talk about this in next few slides, we'll come to know that what is it the minimum thing that needs to be reported as a part of the financial statement, what are some of the information that is required to be disclosed, what is it that something needs to be provided in the notes of accounts, what adjustments and all those reclassification which are required, the restatement of the financials, what that how that can be done. So all this will be explained in the coming slide. Now, well, we'll try to compare this with the equivalent international accounting standard. So there is no change. In fact, the objective of the IAS 1 under IFRS is same as that what is there under IND AS. So we'll just quickly move to the next slide. Okay. So let's just quickly spend a few minutes to understand the scope of IND AS 1. So IND AS 1 typically speaks about the general purpose financial statements. So like balance sheet, profit and loss account, other comprehensive income, and the statement of change in equity, plus the cash flow statement, which is guided by separate Ind AS on the cash flow statements. The objective here is to make sure that we are going to cover the all the aspects that are required to be shown under Ind AS 1 with respect to the presentation as per the framework which has been guided by the MCA, which is the Ministry of the Corporate Affairs. And it so Ind AS is largely this Ind AS 1 is largely on the presentation, but it is not going to touch base on the recognition and measurement, because as we move forward, each separate index has its own separate criteria for the recognition and the measurement. So this largely speaks about how we have to disclose our numbers, and how our numbers has to be reported in a form and shape. What should be the format in it has to which in which it has to be reported? What are some of the key points that we need to keep in mind while reporting our number with respect to the restatement, reclassification, or wherever we are doing some adjustments, how those adjustments needs to be managed. As far as scope is concerned, the scope is in line with the international accounting standard, which means that there is no change in the scope, which is vis-a-vis the Ind AS 1. However, there is one exception to this applicability of Ind AS 1, is that the standard does not apply to structure and condense for the condensed financial statements, which is in according to the Ind AS 34. So, Ind AS 34 prescribes separate format for the interim financial reporting, to which these detailed reporting requirement as per Ind AS 1 is not applicable. So we'll just quickly go to the next slide. Okay. So let's just quickly talk about what is the meaning of the financial statements. Financial statements, when you're talking about, these are like again structured representation of the financial position and the financial performance of an entity. So which means that in a particular operating year, how the company has done in terms of the revenue or the expense, and what is the increase or decrease in the assets and the liabilities. All those numbers needs to be reported, just to make sure that company's financial position has been fairly represented, and that representation can be done as per the framework of the Ind AS 1. So typically, the kind of the statements that are used to report those numbers are the balance sheet, statement of the profit and loss account, statement of change in equity, statement of cash flow, notes, and the comparative information. So all these are the set of the information that needs to be prepared as per the Ind AS 1. Most important point here is that when we're talking about the profit and loss account, so as per the Ind AS 1, the profit and loss has been bifurcated into two sections. Wherein the upper part normally shows the profit and loss. That is largely to make sure that we are disclosing all the incomes and expenditure specific to the operations. And then we have another section, which is the lower section, which talks about the other comprehensive income. So which speaks about any income that arise on account of the fair value gain, or any income that has rise because of a revaluation of assets, which is not part of my operating activity. So all those separate income and incomes, largely other comprehensive income, are being shown under that heading. And the objective is to make sure that our operational profit should be shown separately, and the non-operational profit or non-operational. So when I say other comprehensive income, it can be positive and negative as well, wherein my expenses or related losses needs to be shown as a negative, while other comprehensive income has to be shown as a positive. So this is the presentation of the financial statements, and when we try to compare it with the international accounting standard, it is equivalent to Ind AS International Accounting Standard 1. So there is no deviation. So which means whatever financial statements we are using to present our financial performance, that is being that is in line with the international accounting standard as well. So let's just move to the next slide then. Okay, so we'll just quickly spend a couple of minutes to understand some of the key features of the financial statements. When we talk about the financial statement, there are certain key features that is being ensured to be adhered to when we are making disclosures in our financial statement. First is that fair presentation and compliance. We should be reporting the fair presentation of our financial statement, right? To the extent they are fair, I mean, a judicious approach has to be applied. There is no prescription as such, but there are specific prescription in these respective accounting standards which require this specific disclosure under each of them. But what India is saying is that all the present financial statement is to be prepared. This is the fair presentation and the compliances, and with each respective Ind AS definitely has its set of disclosure requirement that needs to be adhered to in the preparation of the financial statements. Going concern basis, which means that whenever we are presenting our records, we have to assume that the business is a going concern, which is not, it's not going to shut in immediate future. We are going to touch base this more in the coming slide. So accrual basis. So apart from the cash flow statement, largely everything is done on the accrual basis, which means that once we have done a particular expense uh, or recognize a particular income, that has to be disclosed in the financial statements rather than on the basis of receipt and the payment. So materiality and the aggregation is again a concept we are going to speak in detail as we move forward. But largely it covers that what is the material item, which is that which has the which the presentation or non-presentation of that fact may impact the decision making of the stakeholders. That is a material. And when we talk about aggregation, it largely speaks about some non-material items which can be aggregated and it is not impacting the decision making by the stakeholders. So offsetting means that which when we are reporting a particular class of income or expense, whether multiple items within that particular class can be offsetted and then can be shown as a single head, that needs to be looked into depending on the case to case. And I think there is separate guidance by the accounting standard in AS 1, so which we are going to see in the offsetting slide as we move forward. Consistencies to make sure that when we are reporting one number, there has to be a consistent approach. Any deviation to any policy changes or any deviation to any of the adoption of the India's or any change in the method of accounting, that needs to be disclosed properly so that the impact of that change should be reflected in the financial statements. So we are going to speak about this in the coming slides. Frequency of the reporting again speaks about the frequency at which we need to report our financial. So largely it's once in a year, but I think with the LODR, which requires the listed company to disclose their financials on each quarterly basis. So we are going to speak about it in the slide, and then the comparative information, which means that whenever we are presenting a financial statement, it has to have a preceding year financials being attached to it, so that we can do a comparative analysis to assess the performance of the organization. So these are some of the key features. We're going to speak about each of these features in a separate slide in the coming. So we are going to speak about each of this section in the upcoming slides. So we can move to next slide then. Okay. So let's just quickly spend some time to understand what do we mean by fair representation and the compliances. So as you mentioned that fair presentation is making sure that our financial statement represent the true and fair view of the financial position, financial performance, and the cash flow. Presentation of true and fair view requires a faithful presentation of the effect of the transaction. So it is very much important that whatever events are being happening in an entity, that needs to be disclosed in the fair manner, and it should have the proper documentation to ensure the occurrences of those events. And it is very much imperative that all these needs to be disclosed as per the IND AS 1 requirement. However, as I mentioned that IND AS 1 itself do not prescribe any methods through which we can determine whether the fair assessment has been done or not. So which means that when we have a certain items and that item is being managed by, or let's say is being taken care by a separate IND AS, for example, in a separate PPE, we have a separate PPE, and then we have separate standard for construction contracts. So specifically, if you're talking about any disclosure or the fair presentation of the financial statement for an item which fall under these specific IND AS, then we have to make sure that we should adhere to that IND AS disclosure requirement. And it is not, I mean, there is no deviation to it that we can deviate from the disclosure requirement which is being prescribed by each of the in separate IND AS. But there is one exception, and what is that exception basically? So, I mean, there is no departure as such from the disclosure, but there are some exceptions to it. What those exceptions? So, in the extremely rare circumstances in which management concludes that compliances with the requirement in IND AS would be so misleading that it would conflict with the objective of the financial statement study framework. So typically, what is the objective of the of our IND AS? It says that objective of the IND AS is to make sure that the fair presentation of the financial statement. But let's say if IND AS, any of the IND AS specifically speaks about a disclosure requirement, which if disclosed in the manner which is being mentioned in that IND AS would mean that we are deviating from the fair presentation of the financial statement, then in that case we can make that departure. But when we make that departure, it has to be explicitly mentioned in the notes or in the respective places wherein it should mention that why that departure has been done and why the acceptance of the disclosure requirement as per IND AS in respective IND AS would mean the deviation from the presentation of the financial statement. That can be specifically called out, then those deviations are still accepted. What it is saying that the title of the IND AS in question, the nature of the requirement, and the reason why management has concluded that complying with that requirement is so misleading circumstances that in conflict with the objective of the financial statement set out in the framework. For each period presented, the adjustment to each of these financial statement that management has to include it would be necessary to present. So typically, there is no deviation to the way the accounting standards needs to be represented and needs to adhere to the disclosure requirement. So which means that if the particular transaction which is falling under any of the IND AS and it has a specific disclosure requirement, there is no exception. Exception can only be there if at all it can be proved by the management that if at all they follow the strict disclosure requirement of any individual IND AS, then it would mean that they are departing from the concept of the fair presentation of the financial statement as per IND AS 1. So in which case, then that overridden or let's say that departure is allowed. So we have shown it with the help of an example here. So if you look at it, a 30 years old land carried at rupees 8 crore must be shown at the fair value, which is 900 crore, as per the solvency regulation, relying on the carrying value of the loan renewal. So basically, what is happening here? So company departs from the IND AS 16, which speaks about the PPE. So typically what happens when we're talking about IND AS 16, that largely speaks about the showing the fixed asset at the cost. But let's say there is an entity who has a land which was acquired 30 years ago at 8 crore value, and if they are going to avail the loan from any of the reputed lending institute, they will look at the valuation and they say that okay, it's 8 crore, then definitely the solvency or the credibility of availing that loan would not be made available to that enterprise. So hence they want to restate their this thing at the fair market value. So what will happen? The moment they show in the fair market value, there would be profit that needs to be shown in the OCI, other comprehensive income. But it has to be disclosed that revaluation has been done and that revaluation was required to make sure that presentation is fair, because without that it is going to have a solvency challenges and the company could not able to avail the loan and the facility which was available to them because the market value of that particular property has inflated to a large extent. So these kind of exceptions can be something which can be still considered as the rarest of the disclosures, but it rarest of the cases wherein departure is allowed, but it has to be disclosed in every aspect, and there is no second way. I mean, if you are making the departure, that it has to be disclosed in the note of the account as well as to the specifically area why that departure has been done, and we have to make sure that the corresponding figure of the previous year should also be make comparable basis that the changes that you are introducing. So this is a quick overview of the fair presentation and the compliances. So we just quickly move to the next slide then. Okay, so let's just speak about going concern. So, as a part of concept, going concern means that when entity prepare the financial statements on the going concern basis, unless the management either intends to liquidate the entity or to cease trading or has no realistic alternative but to do so. So, which means that when entity prepares the financial statement, it is with the assumption that they are going to carry this business for future periods, and that future period, if we have to talk about, is minimum of the 12 months. So, which means that as of now, there is no immediate visibility that companies is going to shut this business in next 12 months, or there is a threat to the operations, or there are challenges, or there are some regulatory matters or change in the economic dynamics which makes a threat to the business, and then they are concluding that they may not manage to they cannot carry the business for another 12 months. So in that case, it means that they have to make that disclosures explicitly and mentioning the reason why they feel otherwise. So which means that when management is aware about the material uncertainties related to the event or the conditions that may cast significant doubt upon the entity's ability to continue the going concern, the entity shall disclose this uncertainty. So which means a situation arises wherein when they are preparing the financial statement and they are aware that they do not have liquidity to manage their operations, and they are not sure whether they are going to manage this with any other funds that are available from in the form of the loans, and they know that they cannot manage their operations for next 5 to 6 months, beyond next 5 to 6 months, and that means they need to mention it explicitly, and they have to mention that why is it so, that they are assuming that is going to happen. So India's one speaks about that management requires to look forward at least 12 months from the date financial statements are approved and check whether the business can continue normally. So which means that at the time of preparation of the balance sheet, there was no threat. But the time, let's say, when they were approving, when the financials are getting approved in the board, which is normally as per the Companies Act 60 days from the last quarter, which is like 31st March, then it has to be done with by 30th May, let's say 31st May or 30th May, 60 days largely is 30th May. So which means that they need to make sure that on 30th May, when they're finally adopting, or let's say if they are board meeting before that, then on that particular day, if they are approving the financial statements, and if they are of view that they are going to have a challenges in terms of the running the operation, they should make the necessary disclosure. But if nothing is there, then it is assumed that it is a going concern. But if they feel that there are some challenges, then it has to be mentioned, it has to be disclosed, and the reasons why they feel so. So we have shown this with a quick example that year ended 31st March 2025, FS approved on 30 May 2025. Management look at the concept and confirm that they are okay to manage their operation through 30th May 2026, which is 12 months from the approval date. And if they feel that there is no threat to it, business can run as it is as usual, then there is no threat to the going concern. But if they feel otherwise, then they need to mention that reasons and disclose that reasons why they feel otherwise. This is about the going concern. So we'll just move to next slide then. Okay, so we are going to speak about two concepts in this slide: accrual basis and materiality and aggregation. I think one point I want to mention here is that at each slide we have mentioned this the difference between the IND AS 1 versus the IAS or the IFRS, and we have mentioned that wherever it is identical to IFRS, we have mentioned that there is no separate treatment in the IFRS, and IND AS 1 is in line with the IFRS. So quickly come to this slide, then accrual basis. So which means that, as I mentioned, that apart from the cash flow statement, all our financial statements needs to be prepared on the accrual basis. So when you talk about accrual basis, it means that the item of the expenditure or income or any other item within the financial statement needs to be recorded basis the recognition criteria for the applicable accounting standards. And those recognition criteria is again dependent upon each of the accounting standard, and it has nothing to do with the actual receipt of the cash or the payment of the cash. So which means that apart from the cash flow statement, everything has to be prepared on the basis of accrual. Coming to the next concept of materiality and aggregation. So an entity shall present separately each material class of the item. So which means that item is material if it is if the absence of that disclosure impact the decision that needs to be taken by the stakeholders. Those are constituted as material, and every material item needs to be disclosed separately. It cannot be clubbed with any other item, and then it can be shown. So it has to be shown separately. All material item needs to be shown separately. And again, when we talk about materiality, each in AS specifically talk about what needs to be disclosed, what needs to be maintained, so that when they are presented, they should present the fair presentation of the financial statement. So when we talk about aggregation, so we know that when we are preparing the financial statements, we tend to aggregate small expenditures, small items, and then we try to, when we club that item, then the final presentation only show the cumulative number. So that cumulative number, when we are trying to show here, is that it should be looked into very carefully. It should not be done that any material item can be clubbed together and shown as a single item. So we need to look at case to case basis and confirm whether the aggregation is possible or not. So we have illustrated with two examples below. So if you look at it, example salaries of 9.8 CR and the travel expense of 45 lakh, these are material amounts and they cannot be clubbed together. So we have to show them separately as a salary item and then travel expense. We cannot club salaries, travel into salaries and then show it accordingly. So we have to show it as a separate line item. And then audit fee when we talk about. Another example that we have shown here is that there's an audit fee of 1.2 lakh, legal fee 1.5 lakh, and the GST penalty of 10,000. These are like audit and legal fee expenses can be clubbed together because it is not going to impact the decision making of the organization, because these are small items and materiality is not there. In fact, the nature of the items is the same. So it is not going to impact the decision making capability of the stakeholders. So again, there is no hard and fast rule, but it has to be kept in mind that whenever we are disclosing the item of any expenditure or income or any assets or liability, it has to be shown separately in the respective financial statement. It cannot be clubbed together with or aggregated. Or it can be aggregated basis the fundamentals that if even if they are aggregated, it is not going to impact the decision making capability of the stakeholders, and hence they can be still be managed in the aggregate manner. So this is a concept of accruals and the materiality and the aggregation. So let's just move to the next slide then. Okay. So let's just talk about offsetting. So what is offsetting? So typically when we prepare the financial statements, we have largely four heads: income, expenditure, and assets and liabilities. And as per the fair presentation, we have to disclose the amount separately under all these four heads as per the guidance which is being provided by the relevant Indian accounting standards. So this largely we should not doing any offsetting, but if at all some offsetting is permissible under the respective Ind AS, that is something that can be managed or that can be done as per the respective Ind AS requirement. So which means that an entity shall not offset assets and liabilities on income expenditure unless required by an Ind AS. Exception: an entity reports separately both assets and liabilities and income expenditure, measuring assets net of the valuation allowances. For example, obsolescence allowance or inventory and doubtful debts are receivable is not an offsetting. So which means that any obsolescence allowance when we are talking about for inventory, that is again permitted as per the Ind AS 2, specifically to the inventory which speaks about it. So which means that again any kind of the offsetting is permissible if permissible under Ind AS is allowed, but barring that it is not allowed. In addition, an entry represented net basis gains and losses arising from the group of similar transactions. For example, foreign exchange gains and losses on the gains and the losses arising from financial instrument held for the trading. So which is like largely Ind AS 109. So all these offsettings are allowed, right? Provided they are guided by the respective Ind AS under which that item falls. But barring that exception, there is no exception. So it has to be disclosed at the gross value for both the for all the income, expenditure, assets, and liabilities. So we have illustrated it with an help of an example. So company has an interest income of INR 10 lakhs and interest expense of INR 12 lakhs. Management want to show only net interest expense of 2 lakh. So in the P&L, what in the AS say, offsetting is not allowed unless specific Ind AS permitted. Since no Ind AS permit the offsetting of interest income with the interest expense, and hence separate disclosure is required for interest income and interest expense. This is to make sure that it has the fair presentation of the financial statement and to bring the better transparency to the relevant stakeholders. So we can move to the next slide then. Okay, let's just quickly talk about the frequency of the reporting. So typically, it is saying that reporting has to be done for a minimum period of 12 months, which is annual period, and we need to make sure that we should prepare our financials basis at least annually. This is the in alignment with the Ind AS. However, at times it may so happen that we need to prepare the financial statement for a shorter or the longer period, and that is again an exceptional basis and not a regular practice. So those kind of things happens when there's some merger, demerger, kind of a scenario, or when company starts a new company, when the company starts a new company and that company itself is starting the operation from mid of the financial year, and in that case, those kind of the scenarios would arise wherein first financial statements would be of lesser period, which is less than the 12 month. But in that cases, if at all, if it was for previous year, there is no financial comparable available, but for those companies who are in the operations and they have to report a period shorter and longer, that can be largely on account of the merger or demerger kind of a scenario in which they have to make sure that they should be presenting these statements for a longer shorter period, then to disclose that reason why they are disclosing that statement for a shorter or the longer period. And in that case, the fact that amount presented in financial statement are not entirely comparable for because they're not having the comparable period for the previous year, specifically for the companies that have started their business and they're in the first year of the operation. Next important thing is the comparative information. So as mentioned that Ind AS permits that there should be a comparative numbers for the preceding financial year, just to make sure that the records are available, and then comparability is there, and that comparability should be which ensures that there is at least two balance sheet, two P&L account, and two cash flow statement, and two SOCE, which is statement of change in equity. And that comparability helps to ascertain by the stakeholders and the shareholders that whether company has performed better or not, and whether they want to keep their interest in the company or not. And if any change in the accounting policy happen, retrospective impact needs to be disclosed, and that comparative analysis has to be disclosed for each of those statements. So we'll talk about more in the comparability, why those kind of reclassification arises because of change in the policy or in the reclassification, and the retrospective impact. So we'll just speak about that in the next slide then. Okay, so we spoke about the comparability of the information. So comparability largely means that we are consistent in terms of ensuring that our financial statement for previous period is consistent with the current period, and hence we can take that decision based on that comparability. But it may so happen that if there is some reclassification or some change in the policy, then in that case a restatement is required, so which means that restatement is required for the previous year plus the opening balance sheet of the previous year. So which means that any restatement on account of the due to the reclassification or any policy changes needs to be reflected, so that its impact can be evaluated with respect to the previous financial year, and retrospective effect for all those changes should be made available at the opening balance sheet for the last year. But however, it may so happen that if it is impracticable to do so, then a departure is required, which needs to be disclosed appropriately in the financial statement, and the reasons for that impracticable situation needs to be disclosed separately. So which means that if at all there is a impractical reason because of which reclassification for previous year is not possible, then the impact of that should be disclosed properly, and it should be shown in the notes of the accounts. So we have illustrated with the help of an example here. In FY 24-25, there was some changes in the presentation, which means that their cloud software subscription expenses, they thought that they need to be showing separately from the IT expenses. They showed it for 2024-25, but for the previous year they could not able to restate it because the information was not available, and it was impossible for them to extract that information. And hence what does that mean? They are saying that reconstructing data is impossible without hindsight estimates or the guesswork. Why is impractical? Historical data cannot be reconstructed reliably. Result, under IND AS, current year shows separate line item as a cloud subscription expense, but for previous year leave as originally presented. Disclosure reason: prior period reclassification impractical due to unavailability, and detailed historical information should be disclosed properly so that its impact can be evaluated by the relevant stakeholders. So let's just move ahead. Okay, let's just talk about the structure of the balance sheet and the financial statements. So structure and the order. So in AS as such do not specify or require any kind of order in which it has to be presented. It rather says the principles that are required in preparation of the financial statement. It says that the order of the financial statement should be systematic, consistent, relevant, and understandable, and minimum information that is required to be available in the financial statement is the name of the reporting entity, whether financial statements are of individual entity or date at which it is reporting, presentation of the financial currency, and the level of the rounding off. See, it has to be kept in mind that IND AS is not explicitly prescribed any format in which presentation of the financial statement has to be done, but it has to be aligned with the Schedule 3 of the Companies Act 2013. So, Schedule 3 prescribe the format in which the financial statement, which is balance sheet, P&L, other comprehensive income, statement of change in equity, and cash flow statement is to be presented. So we have to use that format to present our financial statement, but IND AS explicitly does not prescribe any format. So we'll quickly move to the next slide and see the format of the balance sheet. Okay, so quick view of the balance sheet, equity and liability, equity, then liabilities, non-current followed by current liabilities, other financial lease liability, other current liabilities, short-term provision, current tax liabilities. Likewise, asset sides, assets, non-current assets. So for the simplicity purpose, I have shown it as a two columns side by side, but normally it has to be equity and the liabilities first, followed by the assets and non-current assets. So that's how it's normally being shown. So this is just to ease for the presentation. I've shown it differently. So IFRS statement is identical. An entity shall disclose the amount expected to be recovered or settled after more than 12 months for each asset and liability and line that combined amount expected to be recovered or settled, not more than 12 months after the reporting period, more than 12 months after the reporting period. So these are two things that we are going to consider in the next slide when we are talking about more about in the current and the non-current thing. So basically, the period of 12 months is being given for anything which is treated as a current, and anything which is beyond 12 months of an operating cycle period, that is being treated as a non-current. We'll speak about more this in the next slide. But this is a quick snapshot of the format in which balance sheet has to be prepared. So, quick definition on the current assets. So, entity shall classify an asset as current when it expects to realize the asset or intends to sell or consume it in normal operating cycle. So, operating cycle is the normal operating business. It expects to help primarily for the purpose. So, typically, any asset which is being acquired as a part of the normal operating cycle is normally classified as the definition of the current assets, and and if it is non-current, it has to be mentioned specifically. So typically classification of current and non-current are largely on the basis of the periodicity, and if at all our receivables which is being due from the revenue being generated, if we assume that our as per the agreement terms we're going to get those amount within a period of 12 months, it has to be shown as the current, and if not, if it is more than 12 months, that we normally classify as the non-current. Same holds good for the current liabilities. An entity shall classify the liability as current when it expects to settle liability in the normal operating cycle. It holds the liability primarily for the purpose of trading. Liability is due to settle within 12 months after the reporting period, or it does not have an unconditional right to defer. So typically, the simple classification, if it is 12 month, less than 12 month current asset and current liability. If it is more than 12 months, it is non-current assets and the non-current liability. And most important is the operating cycle. Operating cycle of entity is the time within which the acquisition of the business or processing their realization normality. So typically, it's a period of 12 months, which is being considered as the operating cycle. So 12-month period, less than 12 months, classified as current, more than 12 months, classified as non-current. Typical rule. And it has to be make sure that it has to be for an operating activity of the business. Okay, so quick look at the statement of P&L. So typically in P&L, we have profit and loss account, and then we have the other comprehensive income that needs to be shown below the P&L. And largely OCI records any kind of income which is not from the operations. So we have to show it here that there are certain comprehensive income like items which will not be reclassified to P&L, remeasurement of the defined benefit plans, equity instruments. So all these are shown as separately because they are not from the operations. However, there are certain incomes which are classified as an OCI because of the fair valuation changes, fair market value changes. But when the final realization happens, they can reclassify it as a P&L. Like there are some also example like exchange differences on the translation for a particular year, which is when finally realized that was reclassified as in the P&L. So format shares that we have to have create a P&L and then followed by the other comprehensive income. Okay, so let's just give a double click to understand the other comprehensive income in bit detail. So we are saying OCI comprises of the item of the income expense, including the reclassification adjustment that are not recognized in profit and loss as required or permitted by the Ind AS. Okay, other comprehensive income refers to those income expenditures that are not recognized in P&L but are instead recorded directly into the equity under the statement of other comprehensive income as related to the Ind AS. These items bypass the P&L because reason they are long-term financial impact related to long-term financial unrealized gain or losses, which is like largely on account of the fair market valuation, valuation changes, item not arising from the normal operation. So a thumb rule is that if it is not from the normal operation, it has to be shown as an other comprehensive income. So we know that the main intention of Ind AS is to have the equivalence with the IFRS, which is based on the fair market value concept. And because of that, we need to have the fair market value of the certain items depending upon their specific Ind AS. And if at all the fair valuation leads to the gain or loss, that needs to be disclosed separately in the OCI so that it should not impact the profit from the operations. So OCI provide clarity so that PNL reflects the operational performance, most important. So this is the most important point, that this is to ensure that the PNL should only reflect the operational profits and rest is being managed in my OCI. Well, OCL capture the non-operational valuation based on the fair value changes. So two bucket of OCI item that may be reclassified to PNL in the future. So what are those? Foreign currency translation differences, effective portion of the cash flow hedges, debt instrument versus measured as the fair valuation at OCI. So these are three wherein we need to reclassify the the item to the PNL upon the realization. Items that will not be reclassified to the P&L non-recyclable are gain and loss on the revaluation on the PPE, gain and loss of the revaluation of the intangible, remeasurement of defined benefit plans, equity instrument designated FVCOI. These say permanently. So again, equity for FVCOI is irreversible, which means that it has to be shown in the OCI only. But similar debt instrument shall be measured in the P&L once it is being realized at the time of the final sale. So this is a quick show bifurcation of the OCI and the PNL. Okay. So quickly we'll talk about the statement of change in the equity. So entity shall present statement of change in the equity. Statement of change in equity include the following information: total comprehensive income, okay, which we discussed in the previous slide, for the period, showing separately the total amount attributable to the owners of the parent and the non-controlling interest, which is largely the minority interest. For each component of equity, the effects of retrospective application or retrospective restatement in accordance with IND AS 8. We'll speak more about this in the IND AS 8. For each component of equity reconciliation statement, so we have to have a reconciliation statement for each particular item. So this is a quick snapshot of IND AS requirement, SOC as per IND AS requirement, which is prescribed by the Schedule 3. Okay, we'll move to the next slide. Okay, so let's just quickly talk about the statement of cash flow. So statement of cash flow would be as per the prescribed format, which is there in the IND AS 7, and we are going to speak about this when we are going to have a separate session on the IND AS 7. And we'll move to the notes to the financial statement. So notes shall present the financial statement on the basis of preparation, like this is largely the accrual basis, the going concern basis. Disclose the information required in IND AS that is not presented elsewhere. So typically, each IND AS has specific requirement that needs to be disclosed as a part of their respective IND AS, which needs to be disclosed in the notes to the account. An entity normally represent notes to the following orders. So basically, statement of the compliances with the IND AS, that is the one they need to present. Summary of the significant accounting policies applied. Summary supporting information for the item presented in the balance sheet. An entity must present may present notes providing the information about the basis of preparation of the financial statement and significant change in the accounting policy of the financial statement. So we'll quickly have one more slide on this notes to the account. We'll speak a little more detail about that. Let's just move to the next slide then. Quick on the notes to account again. So as we mentioned that notes to accounts are largely mentioning the facts that what are the basis of preparation of the financial statements, and it also makes sure that we should be disclose all the accounting policies. The entity shall disclose summary of the significant accounting policy, measurement basis based on preparation of financial statement. Entity shall disclose the summary of the significant accounting policy or the other notes of the judgment apart from those involving the estimations. So all those estimations that has been used in preparation of the financial statement, that should be clearly called out so that the people are aware that what kind of estimations has been done, and that management should make the process of applying the entire entity's accounting policies and have been most significant effect of the amount recognized in the financial statement. Sources of estimation uncertainty. An entity shall disclose the information about the assumption it makes about the future and the other major sources of the estimation uncertainty at the end of the reporting period, and that have significant risk of resulting in material adjustment of the carrying amount of the assets and liability for the next financial years in respect of those assets and liabilities. So if at all there is some uncertainty which is expected by the management on any of the assets and liabilities, that uncertainty should be disclosed, and the assumptions and the basis on which that uncertainty has been created has to be disclosed explicitly in the financial statement, and typical cases wherein management is not certain for managing the operations for next 12 months as a part of the going concern, that should be also disclosed as a separate note in the balance sheet, which is a very crucial to ensure that whether entity is going as a going concern or not. So notes to accounts are largely to ensure that whatever basis, fundamentals, what are the reclassification policy changes, any uncertainties, any estimation that has been used to create the financial, that should be disclosed properly so that its impact can be interpreted by the relevant user for their own reporting purpose. Okay, so this is the final slide on the key differences with the gap. It's being self-explanatory here. However, we are going to touch base in to each of these specifically when we are talking about the each India separately. But let's just quickly have a look at some of the key differences. So explicit statement of compliances. An enterprise shall make an explicit statement in the financial statement of the compliances with all the Indian accounting standard, which was not there in the Indian gap earlier gap. Current and non-current classification. Ind AS requires presentation and provide criteria for classification of current and non-current. We discussed that. There was no such requirement. However, Schedule 3 provide the guidance on the same. Inclusion of the comparative. Ind AS, an entity shall include certain comparative information for understanding the current period's financial statement, which was not there in the earlier accounting gap. Comparative balance sheet. Ind AS requires presentation of balance sheet at the beginning of the earliest place when the entity applies the accounting policy retrospectively or make the retrospective restatement of the item in the financial statement or when it reclassify items in the financial statement. So that was not there specifically in the Indian gap. So basically when we talk about the restatement, we said that there were three balance sheets. So one is the previous year balance sheet, which is current year balance sheet, previous year balance sheet, and the opening balance sheet of the preceding year, and all the changes retrospectively should be accounted for in the opening balance sheet of the preceding year. Extraordinary item Ind AS prohibits. So this is another more important, that it does not speak about any extraordinary item. It speaks that every item is in normal course of operation, and if at all it requires some specific disclosure, it has to be disclosed separately. But it does not speak about extraordinary item. So classification of long-term loan arrangement. Ind AS clarifies that long-term loan arrangement needs not to be classified as current on account of the breach of the material provision for which the lender has agreed to waive before the approval of the financial statement for issue. Okay, so which means that Ind AS clarifies that any long-term arrangement need not to be classified as current on account of breach of material provision. So if let's say any breach, it should not be say that that breach should be treated as that fact that the amount should become payable immediately. It is still be classified as the long-term loan. So any breach in the long-term arrangement will not itself convert that into long-term liability into short-term, or it has to be shown as a kind of a current liability. In respect, okay, in respect of the reclassified item, Ind AS requires disclosure of the nature, amount of the reason, reclassification notes in the financial statement. Statement of change in equity. Ind AS requires the financial statement to include the statement of change in the equity to be shown as a separate statement, which was not there in earlier. Ind AS requires the entity to shall present a single statement of the P&L account with the profit and loss of the company, which was not there earlier. Ind AS requires the requires the classification expenses to be presented on the basis of the nature of expenses. So all these requirements which are there were not there in the earlier gap, and because of which this Ind AS is much more advanced, or let's say much more closer to the fair presentation of the financial statement. So with this we largely come to the end of this session. Let's just move to the closing slide. Okay, so quick summary slide. So Ind AS 1 foundations are fully aligned with IAS 1, so which means that there is no deviation from the international accounting standards. Difference lies mainly on an Indian regulatory format, which is fine. Forms are based standard for all the Ind AS reporting. So this is the final slide. We'll just move to the closing slide then. Okay, so this is the thank you slide. So I would like to thank all my viewers and subscribers for watching this video till the end. You can share your comments in the share your feedback in the comment section, and let us know what you think about this session and how it has actually helped you to refresh your understanding on the Ind AS 1. We are going to come with the similar session on Ind AS 2 within next couple of days, and stay tuned to this channel Watch our other videos plus this Ind AS video, share our video, subscribe our channel, and like our video. Till then, thank you and goodbye.